The challenge is to be truly diversified, to build what is called a non-correlated resilient portfolio, to build true financial security. You need to be in dozens of completely different industries which behave differently and have different market fundamentals, so that you can go to bed at night knowing that you're in a good position.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Mr. Patrick Grimes, thank you so much for joining us on the show. Founder and CEO of Passive Investing Mastery, international bestselling author, Forbes Council contributor, serial entrepreneur specializing in alternative investments. I'm super excited to have you here. Great to talk to you. Just a couple minutes ago, learned that you are in fact in Honolulu. I love that too, Honolulu, Hawaii. Your portfolio is diversified across energy, across litigation finance, commercial lending, acquisitions, retail, industrial, and thousands of apartment units. I'm super excited to have you here because you are the type of person I would want to be here talking to the listener, the tech professional. And so introduce yourself for us, please. How would you describe yourself, and just give a little bit of background for who you are too?
Well, I love being here because you're my people. I was I was a high-tech automation and robotics engineer, right? I did mechanical engineering in school, and I actually did programming before that. So I was doing .NET stuff and old school web stuff through college. So I mean, my background's very similar to yours, and probably like many of you and the rest of your listeners, it's difficult to find how to invest. I did projects with Facebook and Google. I didn't do anything with Amazon, but I did Lockheed and Raytheon and Abbott and Johnson and Johnson. Very few of the people that I was working with, some of the smartest people on the planet, very few of them actually knew that there was a whole world of alternative investing strategies. And all they knew was, like me, the 401k, IRA, company stocks, Bitcoin, this stuff that
Yep.
I was just riding these waves of instability. I think I got a little bit lucky. I mean, I didn't come from any knowledge. My parents were educators, and but the first company I worked for, the machine design firm, the owner said, "Hey, look." When I asked, because I asked him, "Where should I invest?" He goes, "Hey, I made all my money in real estate. So
Nice.
when put everything that comes out of high tech, dump it into real estate. My only regret was not doing more sooner." And that's when it sent me down the path to lose everything in 2009 and 10, but at least it got me along the path of alternatives.
Awesome. So, I mean, that's I love hearing about origin stories, because just like you're saying, it's the same kind of thing. I joined tech and I'm like, okay, all these smart people, but like what else are they doing? Wanting to model after success, right? But you don't really hear anything about really alternatives. You hear about people have a rental and something else. But not really about alternatives. So what was the first things that you invested in first? Was it like single family home stuff?
Well, so back in 2006 and 7, when I was a snot-nosed engineer, just graduated from college, determined to, double, triple my get rich quick, I invested in some more risky speculative pre-development. And I personally guaranteed the loans. And unfortunately, that very overnight, right? It was brutally paying for years after 2009 and 10 before I finally had to exit through foreclosure. And then the bank, essentially wrote it off, which means I was paying debt forgiveness on the loans. It was pretty brutal. And it wasn't for quite a few years. And at that point, I was like, well, let's just double down on my career, kind of, battered and bruised, ego hit, broke, needed to, still a talented engineer. Thank goodness.
Yep.
Something about being a working professional means that, worst case scenario, you go back to being a well-paid engineer. It's not like you're on the
Yeah,
street.
exactly.
So you can in America, it's pretty cool that you can have another go at it. So I got a master's in engineering and I got an MBA, and I started as a bigger fish in a smaller pond. started doing well. Actually, with Tesla was one of my big customers at the time, doing robotic assembly for them as a contractor, and uh, I I started researching again, like where to invest. The breadcrumbs of the wealthy led me back to real estate, but not speculative stuff. Cash flowing income producing in what I learned were recession resilient markets, and found myself from California buying in Houston single family properties, renovating them, refining them, and renting them, and then repeating, doing the Burr method before I knew
Per method.
what the Burr method was, right, back then. So that was kind of my, when it was working, but it was brutal, right? I mean, that is working a highly demanding job while moonlighting single family. That was tough times.
Yeah, definitely. Especially because, like, how are you getting those initial leads? I mean, you're talking about, doing this something basically cross country. Did it ever, what kinds of thinking were you doing too about doing this not in your backyard, but across the country? Did you have any reservations about remote investing?
Well, I had more reservations about investing in California at that point because I'd seen the waves that the real estate markets take in some of those more volatile submarkets. So if you look at like Fred, you can go to the Federal Reserve online and you can plot out, like, here's the stability of all kinds of markets. And in my litigation finance deck, I'm still going to that same website. I'm still plotting trends, economic trends, and putting it in there.
Right.
But back then, we're talking, I don't know, was that 15 years ago or something? I was in there and I was plotting all the different markets for, different kinds of asset classes and different kinds of locations. And I found Houston because Houston really did support the resilience. It had that diversified employment, not just in hospitality or high tech, but also in energy and healthcare, as well as logistics and manufacturing, and a
Totally.
broad stack that when 2000, unlike in Phoenix or in Orlando, where it literally 2009 and 10 flipped the market and didn't recover for 12 to 14 years, in Houston, it just kind of tapered off, maybe dropped slightly, and then started going up again after a couple of years. And so I said, look, that's actually what more about capital preservation than I am
Hmm.
fancy growth at this point. So it was worth the pain. And I did build a network. I was able to get out there. I was able to find contractors, property managers. I was able to start looking at deals. I was find some people that would do desktop appraisals, and I was able to pay some wholesalers and
Yeah.
and it worked. I mean, I was doing fine. It just wasn't sustainable. In fact, I
A
got to
lot
the
of
point,
energy.
yeah, and I was doing all the jobs myself. I was underwriting, I was managing, I was just and and when you're doing like full time, right? It just takes a lot out of you. So actually, my wife was there for my very last single family closing. We were in Los Angeles going out to dinner, and I met her in Chinatown. I met the notary there, and I was like, okay, this is the very last single family property. My soon to be wife, right? I was like,
Hmm.
I want to focus on us for a while. So we got married in California, Big Bear, and then Beijing. So
Nice.
success. It was 2.5 years later before I had re-engaged and did my next deal, but I traded up to larger apartments at that time. I partnered with other individuals in other markets, and I was able to find a way that would more sustainably scale while balancing the rest of my life.
Yeah, totally. I mean, I opened up a whole new chapter to focus on too, right? Um, uh, doing, single family, doing all those roles. I mean, did you take it's I mean, obviously or I had heard that you took some trips out there too. So you'd been traveling to Houston already to build up that base of network, shake hands and all that kind of stuff too.
I was desperately trying to get my contract work in Houston at the time. I couldn't get it. I was like, can we get some overlap, please, between a
Yeah.
favorable market to invest in and work in? And I actually wasn't successful. So yeah, even my trips out there were not work related. It was purely just for investments. And you know, yeah,
Cool. So how did you so you were doing single family at that time and you know I am so curious about that aha moment of, if there was one around single family to something like multifamily, because multifamily is kind of like the commercial real estate gateway drug, right? And so, um, did you have an aha moment like that too? Like I can
I did.
scale.
I did. Yeah, my wife is a very successful animation. She got her master's in animation at CalArts, with school Disney started. Then she started at Disney. Then she went to DreamWorks, and now she's a production manager. She's a rock star. And I remember I was she was helping host the animation expo in, I think it was in Glendale, or no, it was in Burbank next to the airport. And I was running down the freeway, and I remember we were staying at the hotel there, and I remember just being so overwhelmed by the number of stuff that I had to do for my day job and for real estate, and then but wanting to support her in what she was doing. And I was listening to a syndicator who was a tech investor previously, had an exit, and then he was just sitting there laying out why single family was just the worst and why apartment buildings, for all the different reasons, were better. And I was like, can I get an amen? And I was like, but the thing is, I couldn't do it myself, and I had lost everything before, and I was kind of a control freak. I wanted to do. I didn't want to risk anybody else's money. Wanted to just do it, all of it on my own, and I wanted to own it all. But then I realized I was doing it at a high cost, and that was the cost of my personal life, family, friends, and hobbies, and my soon-to-be wife. So that was the aha
100%.
moment. I talk about that. After that, I did a ton of research and found my way. But it was, think about, like, back to my roots. It really wasn't real estate that got it. It was more diversification, that because I
Mm,
had a high tech business wise, but where do I go to not be in the wild ride? And that was the message from the founder originally, was, high tech's going to go up and down. It's not going to provide that security for your future family. And so I wanted to find not just real estate. That was one of the allocations. I wanted to find different investments which could build more stability. And that's when
yeah.
apartment buildings became an allocation. That's when energy became an allocation. That's when other things that are more novel, that don't rise and fall with the
Hmm.
stock market, real estate, oil and gas, or gold, or interest rates, other things became very attractive to me that are completely separate. They don't have the same market fundamentals. And that's where you find, why is Patrick investing in the legal industry? Well,
Yeah, I
it's
love
because
that.
they don't care. Like the legal industry simply doesn't care what's going on in the broader markets. And it just, you plot those same trends. It's even better than what Houston looked like, residential real estate in 2009 and 10, because it didn't even take the little dip. The legal industry just climbs, right? And when you can find an industry like healthcare, or like education, or like the legal industries, or quite honestly, CPA firms, or plumbers, or HVAC technicians, those kinds of needs that are essential even in downturns, those are great allocations to make. Why? Because you can put your head down at night knowing, you know what, everything else collapses. I got a couple of things there that are going to come back to me. And that's what we call not just diversification, but we call that true security through investments in what we call non-correlated assets, ones that don't rise and fall, don't have the same market fundamentals, that build true financial, not just independence, but security, right? And so that's what we talk about on our platform, Passive Investing Mastery.
Hmm. Dude, 100%. There are so many bombs that you just dropped right there. Like even things like correlated, uncorrelated assets and security and not volatile markets, etc. But having security and kind of in trust in what you've invested in, so that even if everything goes crazy, like you're talking about, your money, your capital will be preserved, but also multiply. So natural question here, even on the intro, but as you've just named them off here too, there were different asset classes that you've talked about. If I am a newer investor, who has heard, something like you're now the aha moment for that person, that syndicator you listened to when you were running down the road of like, oh man, that's right. Like single family isn't it, but apartments. But he's also mentioned all these other asset classes too. So where shows someone, what would you say for a newer investor, but also someone that maybe has already invested in apartments already? What about these other things? haven't heard of, you know, the litigation asset class or healthcare or energy, but where should they go next? So kind of the more beginner, and then kind of the more the intermediate.
Well, I think everybody, if they take a look at our slide decks, or they just plot, for example, the pie chart of where all their allocations are, take each piece of pizza, say I got this percent here, and then take a minute and then think about, okay, how do I feel about the stability of the underlying market fundamentals of each of these industries or these sectors in today's market? Because my belief is it always makes sense to diversify into non-correlated investments, but does it especially so make sense today? Because in the real estate market, just in 2009 and 10, we saw residential collapse overnight. Well, commercial did not as bad. Right now, commercial's collapsing, right, post-COVID, for all kinds of reasons. You got not just rising interest rates, which decrease the values, but got a bunch of bridge loans coming due while values are down. Your payroll and your material costs skyrocketed with inflation. Your insurance costs gone up 20, 30% or doubled and tripled in a lot of favorable markets. It's a turbulent time. So you got to think, like, any one asset class can't get you there, right? You need to be able to ride the wave. But look at the market overall. It is incredible and a little bit scary when you think about that the majority of the investors have the primary amount of their wealth in the stock market. 11 out of the last 14 Fed rate hikes ended in a bust. 11 out of the last 14 Fed rate hikes ended in a bust. What does that mean? It means probabilistically, we're all techie guys here, we're not in very good footing. But
Yeah.
let's stack onto that a couple more things. The world's biggest economies are betting against the dollar right now. Let's stack onto that also that we have this trade war going on, which is destabilizing the markets just completely on its own. There's a tornado of different things going on right now, which you can see it. Intelligent investors are going to more safe haven or more non-correlated investments. And you can see it in the price of gold right now. There's a lot of uncertainty. And it's not fear, it's calculated risk adjusted return of your whole portfolio. And so I say to that pie chart, think about the stability of your allocations, and then imagine, like, well, what if I did add a slice here, right? Where, man, maybe it's in the legal industry. Well, how's that done during downturns? It hasn't cared about a downturn. Well, what kind of returns would that provide? Like, would I feel better? Certainly, there's a journey required where you need to learn about a new asset class, and you need to take some risks and maybe do an allocation that maybe feels uncomfortable. But does this state of the world when you go to bed at night, after you've done that work, you've made that allocation, does your new portfolio allow you to sleep a little better at night? And it does for me. And each of those steps, while it's taken some time, I love to learn. I have that going for me, a general sense of curiosity. And I get to do what my passion is. I just really like alternative investing. So, but at the state of the world, each step you make down this journey, the more security you have. And it helps not just in your way you view yourself during your day job, but for my wife and I, it helped us move away from needing full-time employment, helped us move to Honolulu, helped us give the time freedom that I now have to spend time with my boy at his soccer matches and his, swim meets and stuff like that. So it's done a lot for us.
Awesome. I mean, there's a couple things there, right? You're talking about carving out your allocations and your asset allocation, how people want to invest, right? Where I don't actually know how the litigation finance asset class works, right? But
I can break it down for you.
and I was gonna ask, can you do? I mean, would it be something you can quickly go over? Things like when you're talking about investing in energy, like I could guesstimate, or the listener could think of some things. But what does that mean to invest in energy? What does that mean to invest in litigation finance? I've covered commercial lending previously and some stuff on retail, industrial, and apartments, of course. But I also like what you were talking about for some of those other businesses, for the plumbing business, for HVAC, et cetera. So could you quickly go over things like energy and litigation finance, and maybe even the acquisitions aspect?
Yeah. So first, what I'll say is that it's going to be too much all at once to cover. Maybe we'll just focus on legal
Yep.
industry, because that's very attractive right now. And what I'll say is that the most common question I get is, okay, great, sure, I need to start investing in all these non-correlated or these investments which don't link together for more
Hmm.
security. What are they? And so I just happen to have Patrick's favorite alternative investments that anybody can invest in today. And we just created it like
Perfect.
a month ago to build more security. I have that. It's a download. It's at investwithpatrick.com, investwithpatrick.com. And you can download it. And I like literally, I think 8 or 9 of them right there on one page listed with a brief description. And then it's a choose your own journey because there's a ton of pages past that where you can
Hmm.
go into each of them. And we're not going to cover it all today. Why? Because energy is a large amount of content and there's a lot of different ways you can do it. And so I've kind of, based on different goals, I've broken it down into different pieces. So I'd recommend investwithpatrick.com, download Patrick's favorite alternative investments because it's the most common question I get. Um, but for the legal industry, you could look at, so say it's just like in any of the industries, like in real estate, you got to figure out what to fulfill a need, right? And in real estate, you have
Yep.
these tenants that need housing. Okay. Well, in the legal industry, you have all these attorneys, and they're providing a service. They're providing access to justice, legal
Hmm.
consultation services, right, to individuals. And that industry is very simple. It's You're not building a home and you're not building an airplane with multi-tiered, very complex, bill of material. It's basically hourly rates, court fees, filing fees, maybe some expert testimonies. It's the staff, maybe the attorney's rent. And so they're looking at this going, yeah, this is a pretty simple industry. I just got to trade time for money, and it's
Hmm.
got to be enough to pay my rent, my staff, and all that. And so, but then they run into the situation where there's some really good cases out there where people have been harmed, but they can't afford the cost of litigation, can't afford access to justice. And so, how do they work? Well, attorneys either go pro bono for free or they work based on contingency. And that means they'll say, look, you've got a really good case. I will put up all the costs, but I'll tell you what, I want 40% or I want
Got it.
half of the settlement, right? And I'll do it all. And sometimes it's thousands of individuals that were similarly harmed that need representation or access to justice. And it is at a large organization, even the U.S. government. We have the DOJ as a defendant in our in our litigation portfolio through Camp Lejeune water contamination. We have thousands of individuals that were harmed by the DOJ because they were at Camp Lejeune, a Marine base, where our military, civilians, and their families were fed contaminated water over a 17-year period, and now they have horrific illnesses. And in that particular case, the government said, yes, okay, we'll take accountability for it, liability
Hmm.
for it, and liability for the exposure to these chemicals and the causality that it did cause these diseases. We'll acknowledge that it caused those diseases, right? So there's
Yep.
liability and causality. So what are we going to do? Okay, now here's a law saying the U.S. Judgment Fund will pay these settlements based on how long they were there in their disease. And so now we have thousands of individuals. We're funding the attorneys to go through the process to get settlements. It's not a bad gig, right? I mean, you got a pretty clear idea
Yeah.
what the settlements are. These people really need not like a class action lawsuit where they're getting $50, $70, $80, but we're talking the lowest one's $100,000 and $400,000. These will really make a difference. These settlements will make a difference in the lives of these harmed individuals. A lot of similar cases out there where there's attorneys saying, look, there's a bunch of landscapers and farmers that were harmed by Roundup or paraquat. So we have a couple hundred Roundup harmed individuals that were harmed by Roundup in the fund, where we're contributing towards attorneys who are representing them on a
Hmm.
contingency fee basis to get settlements, which those have settlements been happening. With NEC, toxic baby formula is another one. it's terrible stories, right?
Yeah.
Um, the firefighter foams. Some of the really heartbreaking ones for me are maybe not the mass torts where there's just 1,000 people, thousands in one, but the individual ones like sexual assault. So we have a bunch of sexual assault individuals that said, look, I was harmed by the LA Juvenile Detention Center. And
Mm.
they just settled for billions, and it's in the news right now. And so while we're providing access to justice for those harmed individuals, they're going to see very large settlements, and our investors are going to be able to provide that access to justice, hold that organization accountable, and see and realize really great returns.
Yeah, I think thanks for breaking that down too. I mean, so the kind of boiling a lot of that down, it's and I know just to incredibly simplify it for a second, is that these are the legal firms that will actually draw credit, draw cash, however, get funded, right? Get funded from the fund to go after these cases, right? And that's what is it kind of like a loan basis or something like that to the legal teams?
Yeah, so just like in a real estate deal where we have a debt fund, our income fund, where we're
Yep.
lending to real estate operators
Yep.
that need capital to acquire properties and improve properties so that they can
Hmm.
provide access to justice, and we'll get a lien on the asset, right? Um, we will lend to attorneys, legal operators that need
Got
the
it.
cash to either acquire more clients in their
Yep.
docket of whatever case that they're going after, or operating expenses to get across the finish line. And we will put a lien against the attorney, and
Cool.
we'll advance on a loan to value, similar to a real estate deal. Not usually it's 10, 20, 30% loan to the expected contingency fee, not in the real estate
Yep.
like 80, 90% sometimes,
Hmm.
right? But it's an
Hmm.
asset backed lending strategy. Sometimes they're structured as loans. In certain states, we can do fee sharing. And sometimes we call it some kind of prepaid forward, which is interesting because then it shows up as capital gains and not interest income, which is how our current fund is the majority of our investments, which is really cool. But it's still an asset-backed lending strategy, similar to all of them, and have similar mechanics.
Cool. That's what I was curious about. Yeah, all of that made sense. I just want to know if it sounds like it would be something loan-esque, but like you said, it's kind of case by case where it could be, a percentage of whatever the settlement, I mean, which is pretty much the name of the fund too, right? Um, or similar, but just wanted to understand that part. That's really cool. And I think what's really neat about it too is that it solves a real problem, right? And it's very purpose-based in a lot of ways too, to say that these are the types of things that, um, this fund funds to go after and help the clients, help to actually get litigated, get some kind of justice, and get some kind of settlement too, right?
Yes, and I think that in just like in any kind of investment, you can have highly risky and speculative versions of it. Like in oil and gas, you could be wildcatting, and you could be risking it all and maybe getting 100, trying to get 100x return. Or angel investing, you could be risking it all in something super uncertain early and hoping for 100x return. Just like in any kind of asset class, there are these, like in legal, you can be investing in a case that really hasn't gone anywhere, that's very
Mhm.
speculative, and you're going to maybe make it big. Or you could be really late staged. Quite honestly, I have lost it all already speculating and gambling on speculative real estate. So you can be really late stage, and you can wait until you've seen these attorneys out there get a lot of skin in the game, start aggregating these cases, get them into the courts. You can start seeing how the courts are settling or how they're in the process of settling. You can see, have they already established that this defendant is liable, and whatever that they're liable to having exposed these individuals to, did it cause these illnesses? And then at
Mhm.
that point, are they negotiating settlement? And at that point, the attorneys sometimes say, look, we just need a little bit to get over the finish line, or hey, we're about to settle, can you give us some funds to add more claimants, because it's just for them, it's a cash grab, and for the world, it's more people get a settlement before the judge gavels down, right? And so
Yeah.
we'll contribute in one of those two ways towards the end, but we call it late staged. We call it late staged investments. And when you aggregate lots of different kinds into one diversified litigation portfolio, it helps to provide a great risk adjusted return because you're not in a binary win loss scenario like some investments out there that are really large commercial businesses, one off, right? And you could lose all or make it all in a large diversified portfolio across lots of assets. You're in a pretty good risk adjusted position.
Yeah, I was going to ask that as my follow-up, and I'm glad you not only mentioned the different stages, late stage, I guess somewhere would be earlier stage, and whatever the term would be, something that's mid stage as well, right? Because I was going to ask, like, well, what's the buy box then for that fund, right? And it seems like, how would you articulate what the buy box is for that fund then?
Yeah, so there's different kinds of cases. We'll do some one-off cases where maybe they're groups of one-off cases like the sexual assault. Those are typically individually harmed. Sometimes there's a common theme, hospitals or prisons, right?
Mm-hmm.
And then there's labor claims, like there's maybe an employer or a handful or an industry that has mistreated a certain labor force, right? There's some of that. And then there's large, what are called mass torts. Tort just means harm or injustice. So mass means lots of them. And it's not class action. These are individual lawsuits, but they're settled simultaneously, but individually. And those
Got
aren't, nobody's getting $50, $80. People are getting hundreds of thousands of dollars. And so those have the mass torts typically have 7-year timeline, 10-year timeline, whereas the individual cases, maybe 1 or 2 years. Now,
Yeah.
when we say late stage, what we're really talking about is the mass torts, because if you're really early on, when people are, it's kind of speculative and they really haven't had the experts on the stands testify, battle of the experts and the doctors and scientists say, and they haven't done discovery to really determine, did Monsanto Bayer actually
Mm-hmm.
falsify reports? Did they actually misrepresent whether or not Roundup was safe? And
Mm-hmm.
wait till later. And so when we say late stage, we mean when we got a really clear idea that they are settling or have settled in other cases, and this is a replicated case, or we have a really clear idea where their settlement negotiations are at, then we'll go in and we'll get a reasonable risk adjusted return and produce really strong non-correlated growth to portfolios, but not necessarily get rich, because in this case we're giving a lot of the upside to the attorneys because
Mm-hmm.
they've taken it a long ways, but we're trading that for a lot of the downside protection.
Yeah, and to make sure that you get stable passive income back.
There is no passive income inherently in litigation finance. So yeah,
From the
inherently
fund
in a
though,
real
is what I
estate
meant.
deal, inherently in a real estate deal, there's a tenant paying rent, right? And even in affordable housing, there's the government stepping in and supplementing that rent. But inherently in litigation funding, and this is why they don't get like traditional loans, right, from banks, and they don't get traditional seed funding because they can't partner because of the attorney-client privilege, right? But so where they come to private people like us is because we're actually not giving passive income to our investors, because inherently what we're serving is somebody who can't pay the attorney's rent, right? This is somebody that doesn't have access to justice, can't afford access to justice, and we enable that by funding the attorney to work under contingency. Now, there are some litigation funds out there which are kind of borrowing from the future and leveraging and pushing out cash flow, but inherently in the asset class, it doesn't, and we don't. Now, that said, there isn't, say, a cash on cash return where the asset doesn't push out this amount of rental income, right? Or call it harmed individual income in this case. And a portfolio with thousands of different cases that are settling in our target in 2 to 3, maybe 4, and then potentially we have some taper in years 5 and beyond. There is actually distributions that come out quarterly, right? And those are buckets, not cash flow per se. Those are distributions. And so you're not waiting to the end of a real estate deal. You're not waiting till, you're not cash flowing until a refi or cash flowing into a sale. You've got thousands of lawsuits, and they're going to come in distributing over the life of the hold. And our target is to get in ones that will start in years 2 and grow in years 3 and 4, and taper in years 5 and beyond. So it's not cash flow, but it does distribute.
How is that? Can you explain the difference in? And so I was saying, and that equates to quote unquote passive income, and I meant that in the sense of the distribution model, being someone invests, and they're not invest into the fund. They're not the ones that's working with the attorneys. You and your team are, and so for them, they are getting some kind of passive income because it's not active for them. But instead of you're making a distinction in terminology of cash flow versus distributions, but it still is passive income for the end investor. You're just saying it's not in um, the same amount monthly or quarterly. It's on a quarterly distribution schedule, right?
Yeah, you're exactly right. A lot of our investors come from real estate, and they just have a really hard time understanding, like, hey, what's your cash on cash return? Well, we don't
Right.
necessarily have that. That's not the intent here. The intent is to get non-correlated returns that don't rise and fall and don't care what your real estate and stock portfolio is doing, not to get steady Eddie cash flow. If that's what you want, we have an income fund in real
Right.
estate that gets you steady Eddie cash flow, right? That's the intent here, is to get returns that come back, passive returns, not necessarily to say this is how much you're going to get per quarter. We don't publish that because there's an inherent sense of confusion with passive investors. We publish, here's our projected IRR over the next
Hmm.
3 to 5 years, not when that's going to come back.
Sure, that makes sense. Um, Very interesting. And so, uh, how do how my question is, these attorneys and legal professionals, they know that they can't go to the banks, just like you're talking about, or traditional lenders, AKA, but they need these funding. So, just like, what are one of the two of the ways that these legal professionals get to know you and the fund?
Well, so I have the benefit of having a partner, David Guzman, whom I've been dueling with on alternatives now, all kinds of, for like, I think 4 years now. We've been working, and I'd approached several attorneys to invest in litigation legal funds for 4 or 5 years, and he at the time was at another very large private equity firm for hedge funds, sovereign funds, putting $50 million, $100 million check sizes to work. And
Hmm.
while legal funding isn't very well known here by accredited investors, it's been a huge part of institutional players' portfolio because it's coveted for its recession resilience and non-correlation to broader markets. And the biggest one in America was actually in 1910 against American tobacco, right? When these people said, "Oh man, these cigarettes, they're healthy, right?" And then they got sick. Wait, maybe they're lying to us. And that was the first third-party publicized third party came in that funded against American tobacco and won, prevailed for billions, right? So I have the benefit of working with David Guzman on my team, who has been doing this for 15 years. He's been taking capital in and allocating it towards attorneys, working on contingency for single event and large, called mass tort cases. And so a lot of our deal flow just comes from the relationships he's had, and which is very well established and over century old industry here. It's a $500 million industry here in the country, is mass torts, but he gets the deal flow from those relationships that he's built over that time.
Awesome. I mean, that's pretty much exactly what I was asking, right? You
Mm-hmm.
have you have a partner that has the experience, has that credibility, has the relationships, and knows what the heck he's doing, right? And
Mm-hmm.
so, um, yeah, awesome. There's I'll just ask from here. Is there more information on investwithpatrick.com for this too?
So investwithpatrick.com is where I give away the book and where I have that Patrick's favorite investments. Our investment platform is passiveinvestingmastery.com. And on passiveinvestingmastery.com, we have both the diversified litigation portfolio investment, where we have the replay webinar, slide deck download. You can set up calls to chat about it. We have an income fund for recessionary income. It takes advantage of the high interest rates and the huge demand in commercial real estate for debt. Like right now, we're at very low leverage income fund, and we have an acquisitions fund where we're taking advantage of the best buying opportunity in commercial real estate in my lifetime. We're buying things in cash and we're getting incredible growth. That has a huge wait list, but the income fund and litigation fund are both available. We have plenty of deal flow in both, and that's at passiveinvestingmastery.com.
So talk to me about this. Again, you know, there are many asset classes here. It's education. You have to, I don't need to tell you, I'm telling this to the listener, is continue to educate yourself, right? And so that in mind, there's a bunch of different asset classes here. And you said that they can't start with all of them and they have to look at their pie chart, their asset allocation, and kind of carve out a little bit more of each of those. Do you have on the site which ones might be a little bit more or less, do I dare say, more or less risky, uh, or where like an idea of where someone should start first, because they may not be. Let's just say that someone isn't familiar with most of these right now. Like, how should they navigate what to figure out?
My
There's
recommendation
a
would be to
there's
set up a call, because there's no one size fits all to every investor. Every investor kind of comes from a different place. They're in a different stage of life. They have different net worth. They have different amount of savings. They have different income, and they have different risk tolerances and different goals, right? And so, while I'm not an attorney, a CPA, or a financial advisor, and I can't give legal, tax, or professional advice, I've been out there working my ass off for a long time, for making my way through these alt investments, and I can help. We can help in a lot of different ways. So on our website, Passive Investing Mastery, we do have a bi-weekly alternative investing mastery series. And a part of our mission is to educate to our investors so that they can achieve mastery in the art of alternative investing. And how we do that is we have a weekly wealth accelerator series that goes out every Saturday morning, where I talk about all kinds of different things that I've learned over the years. Bi-weekly webinars with 2 to 3 panelists, where in every single one we introduce a completely different alternative investment, which is
awesome.
me not just trading the baseball cards of alternatives with a couple dudes like I did for decades. Now it's like, here's the entire deck. We're going to bring the experts, 2 or 3, and every different kind of alt assets. And what I really wanted to know when I was back at a high tech professional was exposure to these deals, and an accountable conversation between different experts in them, where they hold each other accountable. We can talk about the risks, talk about the benefits. And that's what this is all about. And you're going to see stuff in there about Forex. You're going to see stuff in there about gold mining investments. You're going to talk about blockchain. We're going to talk about parking lots. We're going to talk about laundromats. We talk about all kinds. And we also talk about strategies related to asset protection and tax and legacy, retirement accounts, a lot of really cool stuff. So we educate through our Alternative Investing Mastery series. And I've got a number of books as well. But if you're interested in one of our specific investments, like the litigation fund, I have a litigation investing mastery series you can subscribe for. We have we have not only webinars, and 2 or 3 webinars, but it drips you out every 3 days for like 20 emails, and it tackles different kinds of perspectives on investing in litigation or legal funds. And so the reality is, it all starts with an introductory call, right? See where you're at.
Yep.
And if we're not the right spot along your journey, we have about 50 other replays for completely different. I mean, you could be the guy that's like, hey, I really vibed with your buy an airplane for cash flow, and that's what I want to do with my life. And that's great. Go do that, right? Because if that aligns with your passion, we have the guys to go do that with, right? And and right there in our archives. So if you set up a call, get you pointed in the right direction.
Yeah, exactly. And I like how you. That's what I was looking for too, right? even if you're just going to dive in, you have material that is on a specific asset class over time so that you know what to focus on and like, okay, this makes a lot of sense. This fits what I'm looking for. This is a good one to go forward with, along with all those different calls too to get exposed. I mean, that is more than half the battle, right? Just seeing all of those different asset classes to be aware and diving into. Um, One of the things, maybe I only have a little bit of time left with you, but I'd love to hear some insights that maybe aha moments you had about the power of working with your partners, because there's a lot of asset classes here. And there's no way that, you know, someone can even start to think of doing anything on their own. You have to work with partners. What have you learned about the power of working with other people? Because I want those insights to extend to the listener to think, well, I do have to partner so that I can become a professional investor versus think about I have to, go and get all these things on my own.
Well, the first time I didn't partner, I lost everything in 2009 and 10, right? And the second time I was successful, but I lost track of my family, friends, and hobbies, right? Because I was working so
Hmm.
hard in single family that I really started to kind of miss my journey, miss my direction in life. And so it was not until that I learned the skill of partnering that I was able to find something where I fit a cog with others and I was able to sustainably scale. It's not just in one asset class too. You got to think about if you're a lawyer or you're in computer software, or you're a doctor, you spent 5,000, 8,000, 10,000 hours developing
Yep.
mastery in that specific trade. But if you want to have a secure investment portfolio, it's not just real estate. It's not just oil and gas. It's not 10,000 hours in one more thing. You don't want to go back to pre-med. You don't want, I didn't want to go back and take electromagnetic and static physics again for a completely new, who wants to do that? But the challenge is to be truly diversified, to build what is called a non-correlated or resilient portfolio, to build true financial security. You need to be
Hmm.
in dozens of completely different industries which behave differently and have different market fundamentals so that you can go to bed at night knowing that you're in a good position. But that means you can't do it yourself across a dozen different completely non-correlated investments because inherently they're different. So the only way to do that, to find your journey, is to learn how to partner. And I've had a lot of success and I've had some failures along that journey. But you don't you can't run any home runs unless you start swinging. But that's
Yep.
really the only way to step out there and build that stability. Is eventually you got to learn your position and your role, um, and start partnering.
Yeah, definitely. You said this skill of partnering, and I agree. Do you also tried to like get the takeaway or one of the takeaways here? Would you say that it's learning to partner and having an investor mindset, investor frame of mind, because then you can kind of go anywhere, right? What would you agree with that?
I'm not sure if the investor frame of mind mindset is, but I've always kind of subscribed to. Uh, there's a lot of people out there that aren't real, and I've always kind of battled through investments by digging in and learning a lot and finding those that are willing to work with me through that. And I've always kind of vetted partners through the trenches of getting shit done and asking questions and digging into the details and seeing where they're at and how long they stick with me. Um, but I think at the other outside of that, you if your desire is to have a well balanced life and you're really good at being a software engineer, really good at being a doctor, really good at being an attorney, if what Steven's suggesting is the investor mindset, meaning, look, you're really good at this cash flow income producing thing and you want to then allocate to other individuals, that's a very amicable way to go about life, right? And if you think about it, you work cross functionally in whatever you're doing with a lot of individual experts. And me as a machine design, automation, robotics engineer, I couldn't function unless I had 12 20 other people that I was trusting to do their role. And it's not dissimilar in your investing career. To have a truly balanced portfolio, you've got to learn how to integrate and work with others. And if you're the capital source, if you're the investor, then you've got to trust but verify that the other side is in fact doing what they said they were going to do and performing in those ways.
Yeah, that's how I was using that as a frame of reference. So definitely. And you did talk about a book. I wanted to make sure we hear about that too, because you're talking about if you are someone that dives in, and there's a lot of resilience here too, right? I think that those are absolutely needed as part of this whole journey too. So tell me a little about the book, and what's where can people get it? I think it's a free copy as well, and yeah, what can they expect to find there?
Well, and so investwithpatrick.com has the Patrick's favorite alternative investments anybody can invest in today to start building security. On that page also, as well as at passiveinvestingmastery.com. Passiveinvestingmastery.com/book. That's the secret link. And if you put the name of this podcast in the promo code, that's the key. If you leave that blank, I'm not going to send anything to you. But if we know where you came from and you're a trusted source, the book, we have a couple books, but the most recent one is Lessons from Thought Leaders. And it was a really cool book. I mean, you got Phil Collins, lead guitarist of Def Leppard here, an actual rock star. I'm over here next to a Navy SEAL, and there's some
Nice.
NFL, NBA players. Brian Tracy did the forwards, Tom Ziegler, Dennis Waitley, Kevin Eastman. Really, I mean, just some mind-blowing people that just communicating with these guys and being in the same room changed my life. They tell their stories. I tell mine, the ebbs and flows from losing it all in my first go to making my way into single family apartments and alternatives. And if it helps inspire you along your journey, then it's enough for me. Hopefully it results in us having a conversation at one point. Love to be a part of your journey. But go to passiveinvestingmastery.com/book. Make sure you put your information. You can choose to download the ebook or download the ebook and get a copy that's signed. And that'll go shipped out to you for free.
Cool, man. I'll be sure to get mine as well and make sure that link is in the show notes too and gets blasted out. Appreciate you. You've given us a bunch of links. I imagine all those places are places we can connect with you, Patrick. Is there anyone else or anywhere else that you would like people to go to connect with you in addition to that?
No, I just challenge people to go home tonight, think about their pie chart, thinking about the stability in these crazy times we're in right now, and think about, well, what a non-correlated, little lesser known alt asset in there that is fairly stable in downturns help. Go to passiveinvestingmastery.com, set up a call. my calendar's right there, and be happy to help get you pointed in the right direction.
Awesome. Thank you, sir. Appreciate you being here. I look forward to future conversations.
Thanks, Stephen.
Cheers. Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.